December has, in the past, been a good month in the markets, in US election years at least, certainly producing higher returns than the historical average. And the good news is it doesn't seem to matter whether a Republican or Democrat wins the keys to the White House. What really matters is that there is a clean win, either one way or the other. At the time of recording, it seems that Joe Biden is pulling ahead, but one also gets the feeling that the proverbial knives are being sharpened for a legal tussle. Welcome to today's IG Trading the Markets podcast. I'm Jeremy Naylor. Today we're back with a well-respected market commentator, Chris Bailey, founder of research house Financial Orbit. We're going to be talking stocks today and sectors to watch out for from the US election, also with the backdrop of COVID-19. Chris, welcome. I'd hoped that by now we'd have had a clear winner so far as the US election is concerned, but is often the case. The markets have to bend to price in all eventualities. I want to get on to the subject of COVID in just a couple of minutes' time as a big sort of shadow that's overhanging things at the moment. But first, what are your thoughts about a protracted outcome? What's your advice about this US election?
The advice, as always, with elections is to keep watching the news flow, but not to base absolutely everything on a sort of a binary, this person wins or that person wins sort of backdrop. I would completely agree with your introduction that it does look at the time of us speaking that Joe Biden's going to become president, and that also we're going to have a Senate in the US, which doesn't allow that sort of blue wave to occur. And markets hence are making the decisions off the back of that. It may change. I think, fortunately, we're going to get clarity, at least from an initial technical point of view, over the next couple of days. But I think from a slightly longer term perspective, over the next few months and into 2021, clearly we're at that point where the absolute huge faith and allocation love that we've seen for American assets has to be reappraised a little bit. And I think that's an important sort of driver for global markets all around the world from the context of the next 6 to 12 months.
But what about this big shadow of COVID that continues to overhang the markets? When we spoke earlier in the summer for another IG Markets podcast, we were talking then about earnings amidst COVID-19. Here we are, in some respects, in no different position, although, of course, the summer produced some somewhat better times for us all in terms of being able to get about a bit. But here we are now, back down with lockdowns, and sadly worse for many. We have to bear in mind those that bear a heavy burden because of COVID-19. But since we spoke in the summer, we have had more record highs for Wall Street benchmarks. What is going on? Just remind us about the effects that COVID had on the markets and why we've come out of that quite strongly. And where do we go from here?
Yeah, it's been, putting aside the clearly terrible human tragedies and costs associated with the pandemic, from a very narrow market participant's point of view, this has been a very fascinating and in a way kind of illuminating sort of story as to the impact of not only big exogenous macroeconomic events, which is obviously the pandemic, but also the influence at the margin of policymaker stimulus actions. I think when we write the financial market history books on the COVID-19 impact, we'll conclude that actually policymakers saved the day. And that is obviously central banks doing QE, slashing interest rates to next to nothing or negative in some cases. But also the fact that governments around the world have expanded their budget deficits materially. Now, stimulus per se is no panacea, and certainly if prolonged, it can actually start crowding out and causing distortions to markets. But at the margin, it actually helped forge the bottom of the markets in late March, early April, not dissimilar to what we saw actually just over a decade ago at the time of the great pessimism around the global financial crisis, when the initial QE policies were adopted. So I think policymaker actions have been hugely influential at the margin, but also we've seen, as I say, the impact of an exogenous shock, the pandemic per se, and how that's induced such extreme sector performance differentiation. And it's not just sort of COVID beneficiaries per se. We can perhaps understand why biotech companies or work from home technology company beneficiaries have done well. But I think it's a bit deeper than that. We've clearly seen an economy that's moved on a pace further in terms of its embracement of digital and e-commerce opportunities. And that's had huge impacts on who are the winners and losers. And I think that's going to be the lingering impact of the coronavirus, which hopefully we move on from a sort of a healthcare and other perspective over the next few months. The lingering aspect is we've had a massive structural shift in the economy toward digitization and e-commerce related activities. And that obviously brings its winners and losers to the markets, and that will continue to influence throughout the 2020s.
And then, of course, as a backdrop to all that, of course, we've got this possible change in political environment. Is certainly if we get a Joe Biden win. What we are expecting a Joe Biden presidency to bring about, if that's indeed what we get, is one where we see more taxation potentially for some of these companies that have done so well out of the quantitative easing and the fact that they get very relatively low taxation environment. Do you think now is not necessarily the right time to change tack economically? Or do you think that the ideas that might be promoted as trying to benefit the markets and, of course, people more broadly, this idea of making government larger, very sort of socialist policies that Democrats have, do you think the time is right, and the fact that COVID is here is neither here nor there, that the economy does need a sort of a more democratic attitude to the economy and thus the markets?
Yeah, it's clearly been a growth trend, the rise of bigger government over not just the last year, actually, for a little while. But I think on the taxation policy per se, governments, there will be a day of reckoning. You cannot run very large budget deficits for a sustained period of time without there being an impact. Similarly, I would still argue you can't keep on printing money at the margin without there being an impact, although central banks have sort of got away with it for the thick end of a decade. So that day of reckoning is coming. I don't think it will be in 2021, though. My feeling is the straw that breaks the camel's back, if you like, will be ultimately the bond market, because at the moment governments can issue bonds which are then either purchased by central banks in part of their QE program or gobbled up by investors who at the moment seem happy to buy bonds of negligible yields, even with quite high durations. That will change over time. But what will bring change to the bond market will be a broader economic recovery. And obviously that's dependent on getting the other side of the pandemic. Now, we've seen elements of that. You know, if we dropped into Shanghai or Beijing right now, we would wander around and think, oh my goodness, this feels kind of normal. You know, people aren't wearing masks, there's economic interaction going on. And we can obviously see that reflected in the economic growth stats and related in China and in many other East Asian countries. So I think the influence of mitigation, us trying to work out how to get the other side of this pandemic without, you know, even possibly without a knockout vaccine, will ultimately bring back growth, and it will bring back a feeling that actually the opportunities in a sort of a broader subset of the market become more interesting, those of a more cyclical commodity industrial nature. But it will mean that the bond yields go up. And when bond yields go up, suddenly governments have got difficult decisions, because suddenly the cost of having to fund and finance their budget deficits will go up, investors will ask more questions, and it will get more difficult. And that's when the taxation will come in. That's something I'm expecting for the sort of the 2022 to 25 period. Clearly, the only way you can offset high taxation, I think personally, is more growth. I think what we'll probably get is a bit more growth, but also a bit more inflation, which again will change people's allocation preferences. So I think smart governments, they will want to get bigger. They naturally have got bigger, but they'll realize that, as history tells us, governments, unfortunately, are not the best generators of wealth over sustained periods. That's best done by the private sector through classic incentives and the profit incentive and everything else. And I think smart governments will understand they've got to give incentives back to private companies and individuals to take risks at the margin and help bring growth back. It's kind of ironic that interestingly in China, they seem to understand that a little bit better than perhaps we at the moment do in the West.
Just before we get into some of the specifics, broadly speaking, are you then saying, therefore, that you're quite happy being in stocks? And are you buying stocks at these levels? As I said, we've seen record highs recently on Wall Street. I know we're just a little bit of a distance away there now, but we're making some good inroads again into some of the shortfalls that we've seen from the records we had back in September. Are you happy being long stocks for the immediate future then?
The answer is yes. And I say that for two or three reasons. The first would be the fact that I can pick up yields in a sort of a portfolio of equities versus cash and bond markets is to me attractive. Not that I'm particularly an income chasing investor, but it's always helpful at the margin and reflects relative value, I think. Number two, I believe that the next broad trend, the tactical trend in markets will be understanding that we can mitigate the highly impactful elements around the coronavirus better. I do think the second wave of lockdowns will be better managed from the narrow perspective of economic growth downdrafts. This is helped a bit by policy, but also experience. Every single company out there has got a better idea what to do to protect their margins and everything else. And us as individuals, again, we're adjusting and changing. It won't feel, I don't think, this lockdown England is entering at the moment and other countries in Western Europe are entering. It won't feel as tight, as restrictive. We've worked out the workarounds, if you like. So again, I think that's helpful for sort of risk-embracing investments. The final reason would be that when I look at particularly equities outside of America, that the level of love, the level of allocation by fund managers around the world is relatively modest versus historical norms. So for me, I look at the sort of the fallout from the American election, and I think to myself, both global, i.e. non-US, and American fund managers will consider opportunities in the Far East and actually the out of favour European and UK markets as being of interest. And that's where my allocations and buying at the margin is focused at the moment.
If you can keep your head.
When all about you are losing theirs.
What possibilities might you see?
If you can see it.
The world is yours to trade and invest. See it. IG it.
How do you advise clients to get exposure to Far Eastern equities? I mean, there's a currency risk beyond anything else, but the fact is that it is difficult, I think, for the ordinary investor to engage with stocks that are even outside the just the close borders of the UK, for example. How do you recommend people engage with investments in Asia?
Yes, it's a good question. I'd say probably there's three sort of levels of engagement, I would say. For a relatively new investor or somebody who perhaps has quite a lower risk profile, by far and away the best way would be through a collective investment. And obviously there are many of them out and around in the market, stock pickers who would choose 30 to 60 companies in a hopefully diversified manner. For those wishing to embrace risk at a slightly higher level, you can obviously go down the single stock route. We are actually very lucky within the UK market that when you look at a number of actually large FTSE 350 companies, something like a Burberry, for example, they generate a large proportion of their profits and cash flow from the Far Eastern markets. And if you look across, let's say, the FTSE 100 or FTSE 350 generally, and the same in the continent as well, you can actually find companies with significant bias and exposure to Asia. So you can, of course, do it that way. And obviously that applies generally to the emerging markets as well. You look at something like a Unilever or a Reckitt Benckiser, whilst they've got solid and important market positions in Europe and the Americas, where's all the growth coming from? It's coming from the emerging markets. And obviously, primarily that's China and India and Indonesia and other places like that. I think for the highest level risk of investor, obviously you can look at single stock opportunities within the Asian markets. And actually, when I look at those markets, it's interesting. Things like the Hong Kong market is very open for international investors. Obviously, it is difficult. You need special institutional links in order to buy directly on the Chinese market. But pretty much a large number of the important Chinese companies out there, certainly the Alibabas and Tencents and the China Mobiles and related, you can buy on the Hong Kong market, which is very open and exposed to international investors. And you can use a variety of mechanisms to access it. And the nice thing in today's world is also information provision is wonderful and certainly different from when I started out. And, earlier today, for example, I was on the Alibaba conference call, which they held in English, and all the numbers are in English. The accounting standards are global. If you are a stock picker plying your trade or looking to buy stocks in the UK or Europe or the States, and you do your due diligence and work, you can do that in large Asian stocks as well, without any problems. So if you want to express themes and ideas, there are ways to do it. And my feeling is, I think, switched on investor make sure they have a good exposure to the broader emerging markets for all the very obvious thematic and structural reasons. And the fact that China is seemingly ahead of the curve on pandemic control has only sort of deepened that in the shorter term.
It's an interesting point, isn't it? You mentioned there the exposure to the international markets with the likes of Unilever and Reckitt Benckiser. I bring those two out because I think you mentioned them well in the context of this global exposure. FTSE 100, generally speaking, seems to move in not a different direction, but at a different dynamic to the FTSE 250. And we always say that the FTSE 100 is an international index, don't we? So you are buying, aren't you, global exposure? Let's look at some more about that, because do you think there's enough variation within the FTSE 100 to maybe keep your risk within sterling and buy those stocks where you do get that exposure in emerging markets to those that sell foodstuffs to Philippines as well as the United States?
Yeah, and particularly if we think about the fact that fund managers around the world are so underweight UK assets at the moment, UK listed assets, I should say. And that to me is fascinating. You look at big fund management surveys, the only area that's more out of favour than the UK is the energy space. And we all know the reasons why energy is out of favour: low oil price, green revolution, and related. So there's a huge opportunity for the global fund manager fraternity to invest more into the UK. And as the laws of supply and demand work, that should, all other things being equal, push share prices up. So I think there is an opportunity there, a particular opportunity in UK shares. I look at global opportunities, but I have to say I am very, very overweight the UK at the moment. And obviously that's nice. I'm a British citizen. I'm excited by that. But when I look at the reasons why, it's because value in the UK is very good. And that's UK listed stocks, some of which are, as you say, very international in their generation of profits and cash flow, but some of which are quite UK centric. And we all know the reasons why the UK is out of favour. It's not so much the pandemic per se. Clearly, many countries around the world have been impacted materially. It's the added uncertainty of the Brexit shenanigans, which, irrespective of what you think about it, is an uncertainty. Everybody mentions that the first thing when I talk to somebody from far away from these shores, the first question they ask about UK investment issues is, what on earth's happening with Brexit? So I think if we get the other side, we get a little bit of clarity, and clearly we come into that important part of the year you would have thought at the moment where we hopefully will get that. I think that means international investors will look at the UK very closely in 2021. We've seen a touch of M&A activity from some of the private equity fraternity, names like William Hill and McCarthy and Stone in recent weeks. And I do wonder whether we will see more of that, because certainly that combination of low valuations, out of favour assets, but inherently sort of many well-run companies, good corporate governance, exposure to international streams of profit and cash flow, that's not a bad combination. And the fact the pound has been a bit disappointing as a performer over the last few years is only an added interest, irrespective of whether you're a sterling investor per se or somebody denominated in another currency.
So do you think then that journalists as a broad profession overplay the downside for Brexit? Because you continually hear these concerns that are raised about if we don't get some sort of free trade deal with Europe, which is looking ever more precarious, it has to be said. If we don't get a deal with Europe and we then have to start making these trade deals with everybody else, are you not concerned about the fact that the UK is not in a good position come the 1st of January? Or do you think that there will be a bridge built very quickly to enable us to open up again on the international markets?
So first, I think that people should, correctly be concerned about not having a deal, just because Britain is very much a trading country, and it's clearly to help facilitate such trading in the modern world. Laws and regulations and agreements are all important. So I think on day one, if there was a no deal per se, would be messy. on the markets. But I think by day 100 and certainly day 1,000 after that point, you would see pragmatically a lot of things go into place. My feeling, though, is that particularly given the economic growth backdrop at the moment with the pandemic impacts, I think the government is likely to take a pragmatic view and sign something which will be a little different, certainly much tighter and less comprehensive than any continued membership of the European Union would offer. But that's the decision being made, and I think pragmatically people would just want to get on with it. And that's what I'm seeing at every company I talk to about Brexit. They're finding workarounds and ways around and how to make sure that they can continue their flow of profits and trade interactions. So yes, I hope there is a deal, just because I think that's an immediate catalyst to get more excited about the UK from an international investor's perspective, the people who have a huge amount of money to invest in the UK for 2021 and beyond. But I think even if we had no deal, would we find good opportunities in the UK market after that day one sharp intake of breath? The answer is yes, because UK assets, I think, inherently are cheap, and more importantly, management teams and brands and everything else UK Economy Inc. owns is actually quite interesting. And because of some of the forces of history and everything else, we've got a lot of interesting fingers in a lot of interesting pies around the world.
How wary should we be, do you think, as investors, of the massive amounts of debt, the debt overhang that we've got? We were hearing today from an authority point of view, the Bank of England adding 150 billion sterling to its debt. It's almost 900 billion sterling now being held on the Bank of England's balance sheets. We know the government's in debt with continually issuing gilts. We've got a situation where companies, as you said, looking to take on debt. That it's cheap at the moment to take on debt, it has to be said, but that could, and indeed almost certainly at some point will almost certainly change. How do we play that part of the market? How do we play the debt market? Do we get worried about it, or can we invest to benefit?
So debt is undoubtedly the biggest killer of equity value out there. Pretty much any position in anyone's portfolio that's down 80-90% is all because that company they've invested in had too much debt, and that's killed the equity value. So debt can be an absolute killer for equities. At the macro level, however, it's a bit more subtle, in the sense that the big debt buildups that have occurred have predominantly been with governments. And less so actually at the corporate level. There is a lot of corporate debt, but not the build-up hasn't been as material as at the government sector. As I mentioned earlier, I think a likely end scenario is that bond yields start to go up as investors demand greater compensation for this massive quantum of debt out there and the issues with that. And that's one way that sort of this comes to an end, if you like. The other way will be that I think the risk is that we'll get a little bit of inflation. We've got central banks playing a bit faster and a bit looser, talking about average inflation targeting, as well as sort of doing QE. Now, the combination of a bit of inflation, higher bond yields and related makes equities a very attractive asset class, because companies have that ability to sort of have pricing power and offset periods of inflation. We've seen that over time. And so I think equities are still the core of your allocation. That's my feeling. And I think they're well set up to actually deal with a period of inflation, or even of kind of debt impacting economies by forcing bond yields up and forcing maybe governments to raise taxes. Clearly, you'll have to make some decisions over particular sectors and everything else, but that was always the case. My feeling is equities are an attractive asset class, irrespective of the debt buildup. But naturally, at a stock picking level, yes, always be careful of indebted balance sheets. As I say, debt is always the biggest killer of equity value.
Let's look at how the currency markets play into all this. What's your view on, well, let's take the dollar first of all, because I think that's important in the context of what's happening in terms of the US election. We've done a number of interviews on sterling, and of course a good Brexit deal could see sterling go to 135, possibly even 140 maybe against the US dollar. But the reverse situation of that, no deal, we could see it down at 125, whatever. How important are the currency markets to our investments as an investor in the markets?
Yeah, they're really important, because I think it was Milton Friedman, the great monetarist economist, who once said the way you change all the prices in an economy by just changing one price is to change the exchange rate. And he was absolutely right. So exchange rates are super important. I think from a sterling investor's point of view, it's been striking how the pound's weakness over the last few years has made areas such as American shares, for example, doubly attractive. You've had great returns per se on average, and also you've had currency, from a currency translation perspective, it's been even better coming back into sterling. So I think from a UK investor's perspective, we're at an interesting point, because my feeling is the pound is quite cheap, and I would broadly concur with your ranges on a Brexit deal sort of day one. But I think if we push it forward to day 100 or day 1,000, is it plausible for the pound to be back in the 140s against the dollar? You bet it is. And similarly, would I expect the euro to be up against the dollar? Absolutely. So I think the dollar going down, and it is overvalued against pretty much any currency you could care to mention. I think the exception of the Swiss franc and some of the Scandinavian currencies. So the dollar going down is, I think, a huge, massive investment theme. And it actually does two things. First, it changes the asset allocation, geographic asset allocation preferences for many investors. Suddenly the US becomes a little less attractive, and both American fund managers looking to diversify out of the States and global fund managers who previously been putting a lot of money into the States may just reconsider a bit at the margin. So I think there's the flow into harder currency areas, Asia obviously being the major beneficiary, but Europe stroke the UK as well. Second aspect is, think what happens in periods of dollar weakness. Those tend to be associated with areas such as commodities outperforming. And a world where commodities are outperforming is also a world where, to think about the previous sort of answer, a world where there's a little bit of inflation, perhaps where you've got some other changes going on, where actually a broader range of assets are likely to lead the markets, a slightly more cyclical, commodity-focused range of assets. And you could even throw in the financials there as well if bond yields do start to go up. So actually, the whole sort of bond yield, foreign exchange, market preference story, it's all interlinked. And I think a very plausible backdrop for 2021 or the next few years in the 2020s is actually some combination of rising bond yields and a falling dollar actually inducing outperformance from markets outside of the States, but also sector outperformance from a broader range of sectors than just those kind of recent working from home beneficiaries of technology or biotech or related. And clearly, that would also make a lot of fundamental sense if we do get the other side of the pandemic. We do find mitigation techniques, maybe even a vaccine over time, but mitigation techniques which allow growth to come back and people to express more confidence about the cyclical outlook, employment and related. So I think it's super important. And if somebody said to me, right, you can look at the financial markets a year hence from here, but you can only look at one price. What price would you look at? Or what stat would you look at? And I think actually I'd probably look at something like euro dollar or dollar yen or something like that. Dollar pound, doesn't really matter, because I think that tells you an awful lot about how the world is getting on or not. And if we do crack on and get the other side of the pandemic angst, then actually there's a lot of different opportunities in the world, untapped, relatively cheap opportunities, one of which, as I said earlier, is undoubtedly the UK equity market per se.
Chris, just one final question. Time's almost beaten us, but I'd really like your view on this if I possibly could. We did a podcast recently with a long-term cyclical analyst, and the view was that out of COVID and all that the governments and central banks would be doing in order to try and steer the economies into a more favorable direction, he said would potentially in the next 8 to 10 years create one of the biggest periods of wealth creation that we have ever seen. Do you concur with that, or do you think that's overplaying it a bit?
No, I completely concur with it, because the thing is, it's funny that the whole crisis opportunity thing is so interlinked. And I know, you can cite in if you look at Chinese characters, they're one side of the same coin, of different coins, basically. But essentially, great crises lead to innovation, and innovation ultimately leads to wealth. And the pandemic has been terribly awful. We all wish it hadn't happened. However, could it allow huge advances in not just biotech and science, but also the way that we interact, the way that we live our lives, the way that we spend our money and do things? We find workarounds and better ways to do stuff. Absolutely. And all of this filters down. And that's even before you start considering the fact that some people will have held money back. They've decided to retain savings rather than spend money, and related. So my feeling is that innovation is the key to wealth creation and hence stock market value and everything else. And we're actually at a moment of huge innovation. It's been driven by crisis, but hopefully we can yield some opportunity from that in the years to come. So I would absolutely concur.
Lovely. Okay, Chris, what a wonderful way to end this chat with you on this occasion. Thanks indeed for your time. We're most grateful for your time with us here on IG Trading the Markets podcast. That's Chris Bailey, founder of research house Financial Orbit. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.